How's it going, Elliot?
Good, good. Thanks for having me on.
No, thanks for coming on. I do appreciate it. A lot of news in the oil markets or the energy markets, which is in the last couple of weeks, because I follow all commodities, which has been really quiet, but not in the oil markets and energy markets.
Mhm.
And probably the biggest change was recently, about a week ago, Saudi. It looks like they're going it alone as instituting another cut. So you're looking at million barrels of production cut starting in July, I believe. So the OPEC cut started this month, and then Saudi's doing another $1 million a barrel. Yet the oil markets, they're up a little bit today, and they were up, I want to say 2% yesterday, but they're still at the bottom end of a floor, I would say. So what are your thoughts on the current energy markets? And yeah, give me your 30,000 foot view as of right
Y-
now.
Yeah, I think the market's main concern has been on the demand side of the equation, not so much the supply side of the equation. We're not actually seeing much sign of demand weakness just yet. I mean, if you look at U.S. oil inventories, U.S. gasoline inventories, U.S. All refined product inventories, distillates, not too bad. In fact, below average for most of those products for this time of year. We're not really seeing much of an impact yet in terms of demand. China had a record demand in recent months, mainly because they had an economic reopening there from sort of that zero COVID policy, and that caused a bump up in demand. So it's really all about the market's expectations. The market seems to be saying, well, we are going to probably see a recession here in the United States, probably in Europe as well. And there are worries about China now. If you look at the real-time data, incoming data, there's obviously some signs of slowing there. I look at things like the Citigroup Economic Surprise Index for China, and it's been really coming off a cliff since March or so, March, April. So there are definitely some concerns there. You saw the Chinese government come out and announce new stimulus measures. So obviously they're concerned about it as well. So I think the market's primary concern is on the demand side. The supply side remains super bullish. As you said, not only has OPEC overall cut production, but we're seeing Saudi pile on top of that in July with an extra 1 million barrels a day of their own production. If history is any guide, Saudi Arabia is arguably one of the only reliable countries in OPEC in terms of doing what they say they're going to do. They will cut 1 million barrels a day. They're capable of doing that. And you also have to remember that we're entering the period of peak demand globally. Most of the world's population lives in the Northern Hemisphere. It's summer driving season. Demand normally picks up this time of year, and you have other issues as well. In Saudi Arabia, for example, it's kind of hot in the summer months, and they use a lot of oil to produce electricity. So their demand naturally goes up in the summer months. So if they're producing less and using more domestically, that also will tend to constrict exports. So I think the supply side of the equation remains very bullish, and you've got that in a push-pull with concerns about the demand side of the equation. And that's why I think you're not seeing oil respond more to this announcement than it normally would. Go back and look in early April when OPEC surprised markets with a cut. And the oil took off, right? Not for that
Right.
long, but for a week or two, at least. This time, it barely rallied one morning before selling off. So I think it's a clear sign that there are concerns about the demand side of the equation, though we're not yet seeing that in the actual physical data on oil. And if you look at the estimates, International Energy Agency, OPEC itself, right, they're projecting pretty tight oil market to end this year, where as we go into the second half of the year, demand is going to outstrip supply. And that was before Saudi announced this cut. So obviously something doesn't add up, right? So either of those estimates are totally wrong, because as the market believes there's going to be a hit to demand because of a global economic downturn, or the oil market is going to be super tight in the second half of the year. So I think that's where we are. Generally speaking, historically, demand-led cycles are shorter lived than supply-led cycles. The reason being is that yeah, demand falls when you have a recession, but usually not that much, right? Globally, because the world, it's the lifeblood of the global economy is energy. You'll see a temporary hit to demand, but it's unlikely to be long-lived. And, the supply side is much slower to adjust. So, we have, you can't just go out and say, tomorrow I want to produce more oil. These take billions of dollars and years to bring a new project online. And supply-led cycles like the 70s take a long time to resolve. Oil prices didn't turn down because demand softened back in the 80s. They turned down because all this new non-OPEC supply came on stream. You had the North Slope of Alaska, the North Sea of the United Kingdom and Norway, Mexico's Cantarell field and the offshore Bay of Campeche. All this kind of came in at the same time. That's what brought oil prices down. So in the short run, I think you could have some more. I do think we'll see a recession, right? So I do think you'll have more volatility from that side, the demand side. But longer term, $70 oil, $65, $70 oil, depending on whether you're looking at, WTI or Brent, is not sufficient to incentivize all this new exploration development work that needs to happen to meet global demand.
Got it. So you said a couple of things there that I want to dig a little bit deeper, and this whole idea of supply. So as I mentioned to you off camera, is that I'm originally from Alaska. So I lived through the boom of that.
Right.
And also lived through the crash of that, if you would, in the mid 80s when, oil just went to the floor, if you would. And I remember, in living through that, I was even as a kid, I was like, why is this happening? And it was exactly what you said. Well, you have the Prudhoe Bay coming up online, or came online, which was great for Alaska, but it was great for the country because it filled the oil coffers,
Right.
if you would. And yes, I'm familiar with the North Sea. North Sea came online just about that time, as well as the Cantarell oil field in Mexico. That all being said, correct me if I'm wrong, those major oil fields are depleting. And so, but I don't see new projects coming online. Again, this is gaming out for the next few to several years. New oil projects that are going to refill those coffers. And we can make an assumption, recession or not, over the next several years, as the third world becomes second world, the second world wants to become first world, they're going to want energy.
Right.
So tell me comment about that, or talk about that, or where are we going to get new oil fields if they're not exploring for it?
Yeah, it's a tough situation. I mean, you can kind of divide the global oil market up into two buckets, if you will. You have the long cycle supply, which is projects like you were talking about, the North Slope, the North Sea. These are multi-billion-dollar, multi-year deals targeting conventional oil fields. So conventional oil fields have a bell-shaped production curve. They ramp up very quickly in the beginning. They typically plateau for a period of many years, and then there's a very gradual decline rate on the other end. Mm-hmm. And the other side of the equation is your short cycle, which is basically means shale, right? Which is, it's a manufacturing process. It's not a traditional energy process.
In the last decade or two, correct?
Right. Really only since 2009, 2010 on, globally has it been significant. And it's a manufacturing process because it's widely distributed. You don't have to explore for oil in the Permian Basin. It's there. It's all over the place. Producing more is a consequence of drilling more wells, right? Which obviously you can't do profitably. With oil prices too low, you're not going to grow your production into an oversupplied market. So I think this meeting the global supply needs is going to be a combination of both sides of that equation. For the last 10, 12, 13 years, as we just discussed, shale has been sort of the only area of growth. There hasn't been a lot of investment, honestly, outside that. So you're right, you have a lot of these conventional oil fields that are in decline. All the fields we mentioned from the late 70s and 80s and more, right? You have all these African oil fields, places like Angola that were brought on stream in the early 2000s, call it the aughts, whatever. Those are in decline. And you have some of the deep water fields in places like the Gulf of Mexico, which are past peak too. So it's not only a question of finding and developing new oil supplies, it's also offsetting that what we call base decline rate. And there are no easy answers. There are very few oil field discoveries out there. You know, I think the biggest is probably ExxonMobil's project in Guyana, which is coming on stream now. And they're really one of the only big companies that's done much in the last 10 years. It's amazing, but you look at companies like BP, what we used to call British Petroleum, Shell, you know, the Equinor, which is the Norwegian national oil company, used to be called Statoil. They have been shifting a lot of their spending to alternative energy, not traditional oil and gas developments. There's not a whole lot there. You're now seeing them just start to shift back. But as I said, it takes years for those long cycle projects to be built and brought online. In the 70s, you know, oil prices started spiking in the early 70s. But it wasn't until 79, 80 that we saw all these fields we're talking about come on stream. You know, a lot of people thought the North Slope was too expensive back in the day, right? It took time to get the investment dollars in there to actually bring it on stream. And that's obviously in a developed country. Some of these other countries around the world where we're finding oil, I mean, they don't have existing infrastructure like what, you know, Exxon's done in Guyana. So it takes time and it's going to be very difficult.
It's very expensive too.
It's very, very expensive. And, you know, one of the things that makes me feel this cycle is going to be even longer than normal in terms of the coming up cycle is, you know, the Middle Eastern countries, Saudi Arabia, UAE, they're some of the biggest investors right now in new exploration development of new fields within their countries. And, you know, you look at a company like SLB, Schlumberger, oil services company, they'll tell you the Middle East is their fastest growing region right now and is likely to be over the next several years. You know, why would these Middle Eastern countries who have better insight into global oil supply and demand conditions than anyone, why would they be investing billions and billions and billions and billions of dollars if that oil weren't needed? It's needed. They need that spare capacity. They know they need it. And that's why they're doing that today. Outside OPEC, though, and that's dangerous because outside OPEC, you're not seeing that. And so in my mind, OPEC is going to become sort of more powerful within the global oil market until you have non-OPEC supply ramp up. And it's going to take years.
Yeah. Well, let's talk a little bit about that because you said OPEC's going to be more powerful. To me, I'm interpreting that, okay, and that's politics, right? And
it is, yes.
So what I guess my question is what is your position, or do you have one, when it comes to, because OPEC is, and I don't know how realistic this is, but they're getting away from trading within the dollar. Is that something that even fits on the radar of the price of oil, or do you think that's even possible?
Right now, I don't think it's likely in the near term because, you know, the U.S. dollar, the U.S. is such a large market in terms of, you know, the dollar hegemony, if you will, is underpinned by, for example, the size of the U.S. Treasury market, the amount of borrowing that goes on in dollars, the control of the banking system, and frankly, you know, the national security, national defense budget being so large. So I don't know that that's a near-term risk, but what I do think is a near-term risk from a political standpoint isn't so much what OPEC's doing. In my mind, you know, whatever you might think about their, you know, policies, right? And, you know, certainly, you know, some of them have not been historically particularly friendly to the West. You know, they're doing a logical thing from an economic standpoint, from their standpoint. You know, if I were Saudi Arabia, I would want to shore up my capacity, spare capacity, because that's what gives me power to pump more oil, bring the price of oil down, or hold barrels off the market like they're doing now, push the price of oil up. You want that spare capacity, so you have that implied threat to adjust production. I think the bigger risk politically is actually from the West. And it is this idea that we can transition very, very rapidly from oil and natural gas over to alternative energy. You will see alternative energy grow, But the idea that, we can get rid of oil in the next 10 years is pure fantasy.
Yeah, that's
Even
absurd.
if it's absurd. And even if the US did, I mean, you're going to have these developed countries, as you talked about, that want to, they're growing and they want to have the things that we have, cars, they want to have, air conditioning in their homes, etc. And
Mhm.
that implies more energy demand. And so policies that discourage exploration development spending, whether they be, difficulty getting permits here in the United States, countries like the United Kingdom with a windfall profits tax on energy companies, or just this encouraging alternative energy at the expense of everything else, focusing on closing down coal plants, focusing on closing down nuclear plants in Europe, you're discouraging companies from investing. And without that investment, then you're not going to have growth in production, and you're not going to have sufficient supply. You can pretend that you will, but you won't. And we've seen it. It's no longer theoretical, right? We saw Germany say, okay, we're going to close all our nuclear power plants. We're going to phase out coal. We're going to discourage natural gas, and we're going to rely on imported, natural gas from Russia and renewables. And it all went, belly up.
That wouldn't work.
Basically.
That went very well.
Right. Right. And now, I mean, they had a warm winter, so they did. Demand was restrained in Europe. But if they have a normal winter, it's going to be a problem again.
Well, I really want to talk about that and natural gas, but before we
Right.
do, because I'm very interested in that market as well. But before we do, what you mentioned permitting and drilling, and being friendly for exploration and production.
Mm-hmm.
Where on the world now can you look? Because it seems like in the West, whether it's Europe
Mm-hmm.
or the US, and that's just not becoming the case. So where are companies looking, and what do you find interesting as far as a geography of the world?
Yeah, I mean, within the US, I still think you can look at some of your core energy states like Texas and Louisiana, for example, remaining friendly towards the industry.
Maybe
For example,
Appalachia, Kentucky? No,
you
no,
can,
or West
yes,
Virginia.
West Virginia, but the problem you have there is the permitting of pipelines, right, to move that gas to
Yeah,
the Gulf Coast.
I didn't think about that. Yes.
It's a problem.
Yeah.
And a lot of those companies have pipelines, existing pipelines, but getting new ones permitted is a problem.
Okay.
And that's why, prices have been so low up there relative to other parts of the country. Again, though, I mean, within Texas, for example, the Permian Basin, which is mainly in Texas, a little bit in New Mexico, there is no federal permitting within the state of Texas in that area. So companies like, Pioneer Natural, for example, they don't really have exposure to this permitting issue that you may have heard about, difficulty getting federal permits. There isn't federal land to drill on.
Right.
Louisiana, for example, the Haynesville Shale, which is a gas play, but very little problem there. And the fact there's a new pipeline coming on at the end of this year, maybe early next year, to move that gas from Louisiana, which is basically on the Gulf Coast, but from where the Haynesville is, a little farther north down to the Gulf Coast. So within the US, I mean, there are pockets where the sort of hostility of the federal government maybe towards the industry isn't as obvious because the state governments are still supportive.
Very friendly. Got it.
Very friendly. Outside that, I mean, I'd look at, for example, the Guyana deal in South America, which is ExxonMobil's the operator. Hess is another company that has a major investment there. That's a world-class play. A lot of that field is profitable at $25 and $30 a barrel oil. They did, in my view, what properly a super major should do, right? When the price is low, you invest countercyclically, which means you get better deals on labor, you get better deals with the local government, you get better deals on oil services to produce that field. And then now that prices are back up, they're bringing new production online to times to take advantage of that. And there are a few other places around the world where you could probably see some growth. I think Africa is another place that I think will be back on the radar screen eventually. But as I said, it's difficult. It's not a lot of the easy to produce oil around the world is gone, right? It's
Right.
already been produced. So the
Right.
focus is more on tight oil shale or deep water projects like
Right.
that.
It's all very expensive. Well, maybe not shale, but deep water is
Yes.
very expensive. So,
Yes. Yeah.
interesting. Let's talk about natural gas. Just to give you some
Sure.
context, I was um, long natural gas and a lot of the equities maybe a year ago. And
Hmm.
this is not my investing and trading acumen. It was just I sold out in December and January, and the only
Hmm.
reason is it just got really frothy,
Hmm.
if you would. But I was very surprised with everything that's going on geopolitically over in Russia, Ukraine, Europe, and I have family in Central Europe, and they
Hmm.
were very quite concerned. And I guess the worst case scenario, or even the best case scenario, is what happened is that natural gas just really took a dive and took it on the
Hmm.
chin.
Right.
And you attributed that to weather. Was there anything else that led to that? As well as I'm actually short term, I'm really looking at, I'll be jumping into natural gas again, just because at these levels, and it's so negative right now, that's to me a buy as a contrarian. So talk about that. What is your opinion on why it fell off the cliff like it just did? Was it just too frothy? Was it just weather related? And yeah, what do you think of natural gas now?
I think there were three things. One thing is the weather, which we've kind of covered, but the other thing was there's a Freeport liquefied natural gas export terminal, which is in Texas, which is about a 2 billion cubic foot a day LNG liquefied natural gas export facility.
Mm-hmm.
They had a fire about a year ago in the middle of June of last summer. And that plant was offline from then through the end of the year and into March of this year. So, 9+ months.
Mm-hmm.
And that's 2 billion cubic feet a day at maximum capacity. So right there, you're looking at 450 to maybe 500 billion cubic feet of natural gas that would normally have been exported, got trapped in the US market. Go and look at the US gas storage right now, and we're about 500 billion cubic feet above normal.
Okay.
So, right there, I mean, if that terminal had been operating at capacity, which it would have been because it's basically delivering against longer term contracts primarily, and it's still very economic to export gas here from the US to Europe, then, we would be pretty much average in terms of, gas balances right
Okay.
now. If it had been a normal winter and that had been on stream, it still, I think, would be quite a tight market.
Sure.
So I think that was a major force, just that right there. The other thing speaks to what you were talking about, the froth, right? We saw gas prices spike in the wake of Russia, which made sense in Europe, right? Because they import a lot of gas from Russia.
Right.
And so the idea was, right, well, they're going to just import it from the United States. But the problem is that they were already importing as much as they possibly could from the United States. The US has a fixed amount of LNG export capacity. And this isn't something, it speaks to the same thing as we were talking about on the oil supply side. This isn't something you slap together in 2 weekends, right? I mean, it takes a long time, years
Right.
and billions of dollars to build these major trains on the Gulf Coast to export gas. And it takes time to get them permitted. It takes time to get approval from the federal government too, right? And the local
Mm-hmm.
state government, et cetera. So it takes time for these things to come online. And there's no way that they could be brought online, in reaction to something like Russia invasion of Ukraine and the interruption of supplies to Europe. As much as I'm sure those companies would have loved to export more gas and sell it at 10 times the price, right? They couldn't because there isn't capacity to do so. So I do think the market got ahead of itself because it
Mm-hmm.
was saying, well, this is great for gas demand, which it is, but not now. We were already exporting the maximum.
I see.
There are new terminals coming on stream, but the biggest one is Golden Pass, which is in Texas. It's not going to come on stream until the end of next year. So it is a longer term demand story. You have quite a bit of capacity coming on stream between the end of next year and say the end of the year after 2025. And so I do think that's going to be a big demand driver at that time, but it's not impacting the market right now
Today.
or a year ago. It will, I think, by the middle end of next year, second half of 2024.
Got it. Well, then that leads me to, again, a longer term play, longer term plays. We talked about the constraints just now in natural gas and then oil previously, but I'm trying to game this out again is that we got to have other sources, right? So immediately I go to two is coal and uranium. Okay. So I'm not invested in them now, but I'm looking at them probably within the next, I don't know, at the soonest 6 months, if not 12 to 18 months down the road. What are your thoughts on coal and uranium? Just because I don't see any other way for, like, for example, Japan just recently, well, in the last few months, they just became friendly again to uranium after after what happened, what was it, 15 years ago with Fukushima? I hope I said that correct.
Yeah,
and
Fukushima,
Fukushima. And then Europe, again, is becoming, well, I don't know if they're friendly or not, but they're becoming more aware, it seems like.
Yeah, less hostile, maybe.
Less hostile to uranium.
Right.
So what are your thoughts? And then coal's dirty, if you would, for, pardon me, for all the coal lovers out there, it's a dirty fuel, but it is fuel.
Yes.
So what are your thoughts on coal and uranium moving forward? And again, gaming this out over the next several years.
I mean, in the short term, coal demand has been very good, partly because Germany has been using so much of it, right?
They have to,
you know,
right?
They don't have a choice. I mean, here's
Yeah.
a country that, you know, started before anyone else with this transition idea, you know, all got upended by the Russia-Ukraine war and the lack of gas supply from there. And now they're burning literally the dirtiest fuel in the world, which is lignite coal, brown coal from Germany, which they've
There's a
been
lot of
mining
irony
since.
there, isn't there?
There is a lot of irony there. You know, there are not that many ways to play it within Europe. Obviously, South Africa is benefiting as a major exporter. There are companies in the U.S. that benefit from, you know, rising coal demand. So I think coal is, you know, sort of an interesting short to intermediate term story. I think the problem with it is just that, you know, as you said, it has a reputation as being the dirtiest fuel. I do think you will see coal plants retired in favor of natural gas over time, which is a much cleaner fuel. But the idea that coal is going to disappear is insane in my view.
It's a pipe dream. Yeah,
it's a pipe dream, and it's something that we've been hearing about for 20 years. I mean, you know, it's been the death of coal has been predicted for 20 years, and it's not happened. And there's a reason for that. Uranium, I think that's a good long-term story. The stock I'm interested in there is Cameco. You probably heard of them. They're a Canadian company. The symbol is CCO there, or CCJ here in the US. And they're one of the world's largest producers of uranium. And they have mines in different places, a lot of them in Canada, for example. But one of the things they've been talking about is, you know, while everybody's talking about, oh, nuclear power, it's going to be too slow to grow, they're signing a lot of long-term supply deals for uranium. And with utilities sort of all over the world. So the demand is there. Prices are rising. We are seeing.
My computer.
I'm surprised mine hasn't jumped up here as well.
Go ahead.
But yeah, it's you know, there are multi-year deals to supply uranium to these companies. So I think that's an interesting play. You've probably seen Cameco stock has started to really move lately. So that would be where I would go with uranium now. I think that we're still early in that process, but I do think you're seeing some turning there. Japan, you know, France, which used to get most of its power, or still does get most of its power from nuclear plants, but their plants are aging and they're going to need to be upgraded, replaced, whatever.
About that, what do you think of the service companies, like all across the board? I mean, is that too early of a play? Because I've thought about that. That might be, again, if you want exposure to the market, to play the service companies.
In terms of uranium specifically, or
yeah,
just
or in general, but yeah, Yes, uranium.
Yeah, I mean, I think the services companies on the oil side are very interesting right now, particularly those that are focused outside the United States, like SLB, Schlumberger. Used to be
Okay.
called Schlumberger, now it's called SLB. For some reason, I don't know. But basically, they do a lot of work in places like the Middle East. So I do think they're going to benefit from this wave of exploration spending that has to happen wherever it happens. Whether it be in South America or Africa or the Middle East, they benefit.
Right.
On the uranium side, at this stage, the only play that I'm recommending is Cameco, because we're early in the cycle, and I like to start with sort of the big blue chip name in the industry to start. I do think it'll broaden out.
Yes, about that. This is what I found, not to interrupt you, is start big, if you would,
Yes.
because that's where the money's going to flow first,
Right.
and then work your way down, if you would. And that's how I've managed and ran my own portfolio probably for the last 25 years, just to start big. So
I think that's true, and that's true in all the industry, all the sub industries in energy. I mean, back in 2020, 2021, the best place to start was Exxon, right? And names like that. Then it broadened out over time, and now some of the smaller shale plays, I think, particularly on the gas side, are interesting. But yeah, start big and kind of. I think that's very good advice. And uranium, I would say, is a little earlier in the cycle than, say, oil or natural gas. I do think there's an opportunity there. It's an industry I think is going to grow. I think uranium prices can go a lot higher, partly because uranium is such a small part of the cost of producing nuclear power. Most of the cost of producing nuclear power is building the plant, and then some of the refining that goes on of the uranium into a fuel. But the cost of uranium, it doesn't matter that much to the price of the cost of nuclear power. So whether uranium's at $50 a pound or $150 a pound, it's still going to get purchased, right? So I think Cameco is a good early way to play that.
Correct. So wrapping up here, is there any one piece of advice you would give our audience about how to structure and build a portfolio, if you would? Where to start? It's probably I don't want to say probably, it's overwhelming to somebody that's starting out. But yeah, how would they start constructing an energy portfolio, if you would?
Yeah, it's a couple of things to keep in mind. First of all, the energy industry, even though I am bullish on it longer term, and I think a lot of these stocks are going a lot higher, it is a highly cyclical industry. So you do see these periods of immense volatility, and that can mean downside. That can be code word for downside in these stocks, pullbacks in these stocks. So I think it's important to take, and one of the things we try to do in our services is, with our model portfolios, is to take positions over time, incrementally get into these things. You don't want to go all in on a particular name, as attractive as it may be. But wait for things to pull back a little bit. EQT is a company we recommend. It's a natural gas producer. It was a great deal I think longer term, if you bought it last year, you're going to do fine. But the price is down a lot, right, with most natural gas stocks. So, take advantage of those pullbacks, basically. Don't think you have to get fully invested all at once. The other little piece of advice that we often give is, energy industry is actually quite diverse. We've talked about oil, we've talked about natural gas, we've talked about uranium, we've talked about services companies, we talked a little bit about pipelines, right? Pipeline companies. They have some commonality, right, in terms of energy demand being good for most of them, but they are not on the same cycle. So keep that in mind when you're investing. Do you want to be more in the upstream, the producers, the downstream, the refiners, the services names? In this case right now, I prefer natural gas over oil exposure right now. So think about that when you're constructing the portfolio, and think about those big, broad categories and putting some money into the ones that you think are most poised to benefit, and try to cover the bases there. MLPs, a lot of the pipeline companies, for example, are MLPs. That's a much more stable business, very high dividend yields. A name like or distribution yields, a name like Enterprise Products Partners. So don't ignore those, even though they might be a little bit more boring. in terms of
Boring's
a
good.
portfolio. Right,
Boring's
right. So
good.
sometimes that's great, especially when the stock market's kind of weak or the energy market's weak. So
Right.
those would be two little things to keep in mind.
Excellent. Well, can you please just briefly tell us about your services and how somebody can get in touch with you? Yeah, reach out and get in touch with you.
Sure. Well, we do have a service called Energy and Income Advisor, which is our flagship energy service focused on oil, gas, uranium, some alternative energy, but mainly the big commodities, energyandincomeadvisor.com. I also have a Substack over at substack.com. It's called the Free Market Speculator. It's
Let me write that down.
Yeah, it's called the Free Market Speculator. It's on substack.com. I do free commentary there twice a week. So if you'd like to sort of get an idea of what we do, some of it's on energy, also other parts of the market, but I do it on Tuesdays and Thursdays at 10 a.m. I have a column that goes out. So that's a great place if you want to get some free commentary about energy. That's a great place to start. I also welcome comments on Substack. You can leave a comment there without paying anything. Ask a question, send me an email. I put the email address there, and I'd be happy to try to answer it either directly or more likely, in a column for that Substack. So those are the easiest ways to get in touch with me.
Okay. Well, I want to thank you so much for your time. You've been very, very gracious. And yeah, I look forward to chatting again here in the next several weeks, a few months.
Well, I enjoyed it as well. Thank you very much.
All right. Thank you.